So as we're getting started, I see people are logging in. Um, Yahira, is Yahira on with us?
Hey, Duncan. Yes, I am.
Hey, can you drop the link in the chat for Tech Talk?
Sure
I think I've got
thing.
it pulled up already. So,
Awesome. Thanks,
So,
Adam.
so
yep.
everybody who's logging in, I just want to say good morning again. You guys are awesome. I love that you are sticking with this and getting all this information from Pastel Enterprise Center. But it ain't over. This is just the boot camp to get you going. And now we got the next steps coming. And so thank you, Adam, for dropping that in there. So y'all know right now, everything is going virtual. Everything is going technology, virtual, web, and you need to know how to do that. You need to know how to use social media, do social media marketing, build your website, do products on your website, like all the technological things that you need as far as your business in this space. They're going to be going. Pastel Enterprise Center is going to do a series called Tech Talks, where they're going to have experts and vendors come teach you again for free. They're going to come teach you how to use technology to grow your business. So Adam dropped the link in there in the chat. I'm going to copy and paste it so I can drop it again. I want you to go ahead and register for the Tech Talks right now. So before we even get started today, while we waiting, because we got about 3 minutes before we get started, click that Tech Talks link and go ahead and register your spot right now. All right, everybody need to be on there. You all need to know how to build your website, how to do Google Analytics, how to do Facebook Insights. Like y'all, everybody needs to learn how to do it. And Passstones is teaching it for free. So go ahead and do it right now. Click the link. I copied and pasted it as well, but click the link to RSVP your spot for the Tech Talks. The link is in the chat. Like I said, we got a couple minutes while we're waiting anyway. You know, right, Adam? They got a couple minutes. Is what better thing to do than set up for the next step?
They do, yeah. Use this time. Make something of the time we've got here before we get started. Absolutely.
And I'm gonna be honest with y'all. I went through the Tech Talk series last year, and one of the presenters taught about digital content. It changed my whole mindset because I didn't know that, like, as a business, quote unquote, you also kind of become an expert at what you do. So training other people to do what you do is a business too. So I learned how to like build stuff on a website where you can have like classes and courses where you're getting paid to teach what you are already doing. And you don't got to do it live. You can like pre-record it and they like pay for the recordings to learn how to do what you're doing. And so I learned that from one of the Tech Talks. So that's why I'm saying, definitely tune in, check it out. It starts in the first week of September. Click the link and go ahead and register right now while we're waiting. We got about a minute and a half before we get started. You can go ahead and register your spot, before we get started. Still got enough time.
And Tech Talk starts September 2nd, and it's a great series. You're going to learn a lot about how to take your business digital, like Duncan said, and how to best use those assets and make them really worth your time, worth your while, and how to use them so that you get a great return on investment, both in those tools and in your time. So it's a fantastic workshop for everybody to take advantage of. I'm excited to attend it just as I'll be there kind of doing some back end stuff, but I'm excited to learn from it even. So if you're a business owner or interested in running a business, this is a great opportunity for you to learn about some of those technology assets that every business should be using.
Yeah, and I'll just say this last piece before I jump off, because I'm on my earpiece on another Zoom call right now that I'm on mute on. But I want to say this. Listen, y'all, Pathstone Enterprise Center is not just doing these workshops just so we can feel good. Like Pathstone isn't just doing this just because it's nice to do and we want to give people information. You understand what I'm saying? The reason that Pathstone is doing this is so individuals can build wealth. We want your business to grow to the point where it is your full-time job, where your business is your job, where you are hiring other people from the community, where you're leaving a legacy for your children. There's nothing wrong with saying, I want to make money. I want to make money. You know what I mean? There's nothing wrong with saying that. That's what Dion told me. She said, there's nothing wrong with wanting to be wealthy. And so these series are geared to build you to the point where your business is making enough money where that's your full-time job. And then Papstone has resources and connections to help you actually get the funding to make that transition where now it's real. So I hope you all continue to stay with it, stay encouraged. Like I said, register for Tech Talks, and y'all have a great training and a great rest of the day. Peace and love, y'all.
Duncan, thank you, sir. Really appreciate it. Great. It's always great to have Duncan in the room. He brings the energy level up about 10 notches, especially from where I am. So great pitch from Duncan for Tech Talks. It starts in just a couple of weeks. So go ahead and register. The link is in the chat right now. So if you guys want to, like Duncan said, go ahead and get started. I know we've got a few people who are just now coming in, but takes like a minute to register for that. So go ahead. It's free. And by free, I mean free, just like this class. It's totally free. Go ahead and register. But while we're doing that, let's go ahead and get started. Welcome, everybody, to week 5 of Startup Boot Camp, Small Business Boot Camp here with Pathstone Enterprise Center. Excited to see everybody back. It's always nice to have a full classroom. I love that. So thanks for showing up, guys. Today we're going to be learning about the fun stuff. We're going to be learning about money and how to understand money. And the goal of today, by the time you leave, is to be a little more comfortable and a little less afraid of budgeting, forecasting, financial statements, and just understanding business finance. So that's it can be daunting. It can be intimidating. And today we're going to work. David Krause is here with us today. A lot of you know David. He was one of the presenters for Money Talks that just wrapped up a couple of weeks ago. So a lot of you know David, and you know how adept he is in simplifying things and breaking them down and making them digestible for everybody. So we'll go ahead and we will move forward. And I want to talk a little bit about kind of the rules of engagement we go over every week. You know, if you're not speaking, we ask that you press that mute button, keep yourself on mute. That just kind of helps with the background noise and things like that. And if you are ready to talk, if you want to engage through your microphone, we ask that you, if you have a headset, go ahead and use that. It makes the sound quality a little more clear than just maybe speaking directly into your computer microphone. But if you don't have a headset, we still want you to feel free to engage, and you can use that computer microphone, whatever's easiest for you. And then use the chat feature as much as you can. That's the best way to engage with us. There's a record of it. If you have questions, that's typically the best way to get your questions asked and answered, is through the chat feature there down in the middle of your screen at the very bottom. And there's a lot of opportunity throughout the presentation to ask questions. And we have, actually, I am running the chat right now. So I will be running the questions and feeding them to David. But yeah, those are the rules of engagement, kind of the things we ask you to abide by. And now I want to kind of talk a little bit about who Pathstone Enterprise Center is. We are a nonprofit community development financial institution. We're a CDFI. We work with small businesses and entrepreneurs, and we make loans for startups and existing businesses. If you're a startup, we can start you around $5,000 and then build you up to the point of, $250,000 one day. And if you're an existing business, we can go ahead and start with something larger, and we can go up to $250,000. And like I say every week, the lending is something we enjoy doing, but I think our bread and butter, what we're the best at in the area, is our free technical assistance, which is essentially free consulting to you. It's the business development education workshops and work in series, just like boot camp and money talks and tech talks. And the next step here, which is next level. It's also the one-on-one assistance we provide with industry experts like David, who's presenting today. It's mentoring and coaching. And some of you have already received your mentor emails. The other ones will receive it today by the end of the day. We've finally got everybody kind of paired up here. And so mentoring and coaching, and if you're interested in mentorship, I'll drop the link here towards the end of the discussion. If you're interested in getting a mentor, if you've already filled that out, don't need to fill it out again. I've already got your information. You're being put in touch with somebody today. So, but yeah, mentoring and coaching is a great tool we have, and it's all free to all of our participants. And then networking. which is an opportunity you can take right now to go ahead and network with your peers and with your classmates here in the workshop series. Go ahead and interact through the chat, and we're going to call on a few people here in a couple minutes to kind of introduce themselves and tell us a little bit more about who you are, what your business is, and what you do. Before we get to that, I want to tell you what boot camp is for those of you who maybe you're new, or maybe you're just not sure. Okay, I kind of know why I'm here, but let me get a better sense of what boot camp is so you can tell your friends. So boot camp is an 8-session class geared towards startups. And the goal of this is to help you better understand your idea, what problem you're solving, how you're solving it, and how you can take the next steps into building your business. It's 8 sessions. 7 of those sessions are classes. It's a classroom structure just like today, and you're going to be learning certain topics. The 8th session, which is September 4th, is graduation. And to be invited to graduation as a graduate, you have to attend at least 4 of the 7 sessions. So we're really just asking you to attend half of the sessions. And a lot of you, just by showing up today, have already met that. So you'll be getting an invitation to graduation here shortly. And it's going to be a really cool event. We're in the process of planning it. We've got a lot of it already planned out already. And I'm pumped. I know Jahida is pumped, and Dion is pumped, and all of our technical assistance providers are excited to see this. So again, if you attend 4 of the 7 workshop classes, you get to come to graduation in that 8th session. So in boot camp, what you're going to learn is how to build your idea, define your market, start your business, understand money, and write a real business plan. And understand money is what we're going to be talking about today. And before we get into that, I want to give everybody an opportunity to tell me and tell the group a little bit about themselves in the chat. And also we will be calling on a few people I'll have Dion calling a few people here in a minute to introduce themselves and tell us about their business and what they do. But first, I want to introduce everybody to a new member of the Pathstone team, and she can choose to say hello or put it in the chat, however she feels comfortable. Taylor Hosby has come on and joined the Pathstone team. She's going to be doing some project work for us, and a lot of you are going to get to know Taylor and get to interact with Taylor for a little bit here in the next few months. You may get an email or a phone call from Taylor, and Taylor is a rock star. We've known Taylor for several months, and we thought it was about time we brought her onto the Pathstone team. So Taylor, if you want to say hey to everybody, I'll give you that opportunity. But I just want to welcome you and introduce you to everybody here, and let everybody know that, hey, you may see some communication from Taylor.
Well, good afternoon, everybody. Yes, I am Taylor, and thank you for that great introduction, Adam. I can't wait to build a relationship with each and every one of you, and I just can't wait to get started. So let's do it.
Wonderful. Thank you so much, Taylor. Thank you. We're excited to have you on board, and I know everybody here is excited to have one more member of the Pathstone team and of the boot camp family here, which we've built this really cool little tribe, and I love it. So now I'm going to hand it off to Dion, our deputy director here in Buffalo, and let her say hello, and then call on a few people to have them tell us about their business. Dion.
Hi, thank you, Adam. And let me personally say welcome to Taylor. I'm just so excited. I have this big grin on my face, and I probably look totally stupid. So it's a good thing I'm not sharing my screen today. But again, just really thrilled to have you on board. I've been wanting to bring you on board since we met, I don't know, when was it? February, I think, of this year. And I am just so grateful for the opportunity to have to finally be able to do that. So I am going to first call on Donna. Hello, Donna. Happy Monday. Do you feel comfortable taking yourself off mute and introducing yourself and telling us a little bit about your business?
Yes. So my name is Donna Edwards, Donna Latham Edwards. I have I'm the founder of Impacted Families Project. So I work on At one time, it started off as me helping with school 31 with their families, because that is my neighborhood school for Broadway Fillmore, and started helping the families with, offering food, anything, mask, especially when COVID started, partner up with Open Buffalo, as well as the Fruit Belt Community Land Trust. Started with them. We used to, on Saturdays, give food to the Broadway Fillmore area, as well as the Fruit Belt area from the Moot Center every Saturday, probably for about 9 weeks. Now I branched off roughly on my own, and we actually having a event tomorrow. So it's really feeding people and trying to sustain them, training them on ecology, the just transition framework, which is just teaching, like I said, about sustainability, and just living in our whole selves, I could say. Yeah. So tomorrow we're having at 1326 Broadway. We're having us along with a couple different sponsors and partners having a food giveaway. We're giving out produce, dairy packages, as well as meat. It's going to be mask giveaway, as well as voter and census registration. That's at Mount Hope Community Church.
Thank you so much for sharing that, Donna. Donna, if you have a link to a flyer or a website with the event information, can you just plug that into the chat, please?
Yes, no problem.
Be able to share that. Fantastic. Thank you. Lakia Flunder, would you mind telling us a little bit about yourself and your business?
Hi, yes. My name is Lakia Flunder. The name of my business is Ciantra's Catering. I specialize in pretty much most food needs, such as catering services, meal prep, personal chef services, like special events, and then even Sunday dinner, like small caterings. A few of my principles for my business is peace, love, diversity, inclusion, and positivity. So my mission is pretty much to just spread that through food.
Wonderful. I love that. I love food. So
Right. Thank you.
Please share your information in the chat. Thank you.
All right, we'll do.
Krishna, how about you? Would you like to share a little bit about yourself and your business? If you are not comfortable speaking, please feel free to share in the chat. Naveen, how about you? Naveen, I see you're off mute, but we can't hear you for some reason. Okay. Makishia? No? Denise, how about you?
Yes, my name is Denise Stevens. I am starting a business which it's called Roy Network. It's a TV platform for people who are influencers, people who have their own shows that they're doing here locally, that they have permissions to be able to upload on television. So I'm going to be, it's really more inspirational, motivational type and educational type program to help bring people to another higher level of consciousness.
Great. And in this day and age, we need that, don't we?
Yes, we sure do.
Thank you so much for sharing. Again, I invite you to plug your information in the chat. If you have a website or a Facebook or IG account, we'll be happy to check you out and follow you guys. And
Okay.
finally, I'm going to call on Jason Hewitt. Jason, if you feel comfortable taking yourself off mute and sharing a little bit about yourself and your business. Happy to hear from you.
Can you guys hear me?
Yes, yes.
My name is Jason Hewitt. I run Putman Golf and Games. I rent miniature golf and carnival games for party rentals or business rentals. It's all portable, fits in a trailer, and take it around to parties or just any sort of event that wants to stand out with something different.
Fantastic. I love that idea, the party on wheels.
Exactly.
Thank you for sharing. Please plug your information in the chat. And Adam, if I have time, I'd like to give another guy an opportunity to share. I'm an equal opportunity kind of gal. So if I have time, I'd love to call in Gerard Morrow.
Gerard speaking. Thank you for
Hi.
calling. Gerard Morel, based in Jersey City, New Jersey. I'm in the ideation stage of a startup, which will be a mobile platform, which will enable organizations to tackle diversity and inclusion strategies and objectives.
Wonderful. Thank you. Did I hear a Bayesian accent?
You heard Trinidadian, but good guess though.
Trinidadian. Oh my goodness. My ear is a little bit off. I apologize. But lovely nonetheless. I'm from Jamaica myself, so good to see some Caribbean representation on the boot camp workshop series here.
Thank you for having me.
You're welcome. And Adam, thank you for giving me the opportunity to get us connected to these small business owners, these wonderful entrepreneurs. Back over to you.
Oh, sorry, everybody. Sorry, I was on mute there. Thank you, Dion. Thank you for facilitating that conversation. I know if anybody doesn't know, Dion loves people's stories, and that's one thing that continues to drive her. And it's I don't want to speak for her, but I know it's one of her major personal motivations for why she does this work. And I want to thank Dion for providing leadership and vision for this program, and for Pasadena Enterprise Center in general. And thank you for helping with the back end production of all this. And I also want to thank Jahida for helping with all of our workshops and leading a lot of them, and for giving me the opportunity to lead this one and do a little more chit chat than I normally do. But Jahida typically does all the design work and all the marketing and all of the graphic stuff you guys see on Facebook and social media and our websites, and also just the presentations themselves. So Jahida does all that. And then right now, Jahida is running the slideshow so that I can man the chat, and so that our presenter, David Kraus, can do his presenting. So with that, I'd like to introduce David Kraus. He is a partner at New Level Strategies here in Buffalo, and he's a CPA, CMA, CFA, MBA. He's probably got a few more acronyms, but I know he doesn't play in the NBA or NFL, but we won't hold that against him. But David is here today to talk to us about business finances and forecasting, budgeting, and financial statements, and to make this a little more digestible and a little less scary for everybody. So with that, remember to engage in the chat if you guys have questions. This is pretty heavy stuff, but please go ahead and put it in the chat. And with that, I'd like to welcome David Kraus.
Thanks, Adam. Can everybody hear me okay? I'll assume yes, unless you guys tell me. Okay.
You're good, David.
I'm real excited to be here with you today. We're going to try to make some sense of business finances. We're going to touch a little bit on, budgets and forecasts, but we're going to spend, I'd say, the majority of the time talking about your financial statements and what they look like and what's on them and how to interpret them as best you can. So we want to get you a little further along with the comfort of all that information today. So that's my goal. But let's lay out some context about why this is important. So if your goal is to launch or grow your business, which I think we all have that goal on this call, then you step back one from there, and you got to find funding oftentimes. And whether it's your funding or a partner's funding or a lender's funding, a lender like Pastone or your local bank at the corner, they're going to need to maybe take part in that. So then you got to back up one step further And that's going to require you to write a business plan, and marketing and your forecasted financials are going to be two of the most important pieces of that business plan. To make that a reality, you got to know your numbers. So that if there's one theme of today, it's know your numbers. And if you don't know, ask. And by all means, stop and throw a question in the chat or hop off mute if you have a question. Because I don't want to be just rambling and lose anybody on a theme. So we go to the next slide now. And like I said, these are the topics of the day: budgets, forecasts, and financial statements. So now if you are one of the people that thinks a budget and a forecast are maybe kind of the same thing, you're not alone. I think a lot of us almost use the words interchangeably, but they are different. So real briefly, the budget is the plan of where you want to go. And it shows your revenues and your expenses, and you're going to create it and then update it at least once per year. And when you do assessment against your budget, how am I doing against budget? Am I over budget or under budget? Those differences are called variances. It's an accounting term that you'll hear at some point. Now, a forecast, on the other hand, is a projection. So forecast and projection are kind of interchangeable words. And that's what's expected to happen. And typically they're updated a little bit more frequently as conditions change. Somebody says no slides are showing. Can you folks all see the slides?
Yes.
You can see them.
Yes, maybe they're on their phone.
Maybe, I don't know. Kiana, maybe you want to reconnect, perhaps? Unless you folks at Pastone have an idea about why she won't be able to see the slides.
Who can't see?
Kiana sent me a message. No slides are showing.
Okay, I'll work with Kiana.
PC.
Okay, I'll work with her.
Okay. Now, a forecast is what's expected to happen, so you update it a little bit more frequently as conditions change. And the thing about forecasts are scenarios. You can create different scenarios. So you would maybe, as examples, you would have an optimistic forecast, a pessimistic forecast, or best case, worst case, and then something in the middle. Maybe you call it most likely or most probable outcome. So that's your big distinction between budgets and forecasts. Now, your financial statements, there's three primary financial statements that every business can generate, should be generating. And those are the profit and loss, the balance sheet, and what's called the statement of cash flows. And they're all different. And I'm going to do my best to explain the differences, why they're all important, and what's on them. So let's first talk about the P&L, the profit and loss. What does it measure? Well, revenues and expenses are the big items. You'll hear terminology like the top line. Somebody says that, they mean your revenue, the top line on the profit and loss, the sales income, and that's an inflow into your business. That's the way I think about it. It's an inflow into your business, because expenses, that's your outflow, and that's listed right beneath the revenues on the P&L for businesses that have goods that you're selling at a marked up basis. You'll have a cost of goods sold item right below that sales. And then below that, you'll have operating expenses. And a couple of other terms shown there. Gross profit, again, for those businesses that sell goods, that's the difference between your top line revenues and your cost of goods sold. And then that gross profit is applied to all of your operating expenses. We'll see an example of a little bit further detail on that later on. Net profit's your bottom line. So you got your top line and your bottom line. If you could go back one, there's a really important point about the profit and loss. It's measured over a period of time. Typically it's a year. That's very, very standard, but they can be measured. You can have a P&L for a month or a quarter or a 6-month period, but it's a period of time measurement. And that's an important distinction that we'll see as compared to another financial statement pretty soon. Okay, now we can go look at the example. And the example business that I have here is Sam's Bike Shop. And this is the profit and loss. And this is typically how a P&L would look. It would list your company, your profit and loss at the top, and then the period of measurement. Because it's important for the reader to understand, okay, what period is this for? Is this a month or a year or 6 months, whatever. So top to bottom, you'll see there's revenues. And in this instance, Sam decided to break out his sales between services and products. Total revenues, 190,000. Now he's going to back out his cost of goods sold to get to a gross profit. And the gross profit then is applied to pay all of those operating expenses. And these are some typical operating expenses that I've listed here. Wages to run the shop, payroll taxes on those wages, insurance, marketing, some professional fees, licenses. If Sam takes travel to conferences, that would go on here. Again, this is a period of time measurement, revenues less expenses. And you'll notice depreciation is on here. That'll come up later. Depreciation is the way we apportion the cost of a capital good, a piece of equipment, a computer, over the period of time that it's expected to provide a service. So you may have spent $40,000 on a piece of equipment to run your business in year one, but if it's a depreciable asset, then that over a 5-year period, then let's assume it would be a 5-year depreciation schedule. So you would charge $8,000 of depreciation on your P&L each year for 5 years. That's the idea with that. So then you would have your total operating expenses and your net income at the bottom. Now, before we go to the next slide, I'm sorry, catching you by surprise here. Your lender might oftentimes take earnings, which the term earnings is going to be oftentimes interchangeable with net income. Then they would earnings before depreciation, interest, taxes, EBITDA. That's a term that you might see or you might hear, because they want to know from a cash basis. Those are basically your cash-based earnings then. They want to know if you can service a loan. So much of that information to capture an EBITDA figure would be right on this P&L. So now we can go to the next slide. Now the balance sheet. Remember, for the P&L, I said it's measured over a period of time. The balance sheet is measured at a point in time. You can see from the bottom bullet on that slide. Point in time measurement. Why does that matter? Well, because it gives you a sense at a point in time as to the business's assets, liabilities, and equity. All right, now what's typically on your assets list on your balance sheet? Well, we'll see an example of this in a moment, but it often is broken into current and non-current, and current is usually defined as within the next, it's supposed to be liquidated within the next year or operating cycle. So things that are on the current side of your assets are cash, your bank balances, for instance, your inventory, because you want to sell that in the operating cycle or within the next year. And then accounts receivable, if you sell on credit to your customers, hopefully they're going to pay you within the next operating cycle. Now, non-current assets or long-term assets, land, equipment, those are two examples. Computers, if it's a 5-year asset that's depreciated, then that would go into a long-term asset. But the layout on your assets, it's important. It's the layout top to bottom. Think of it top to bottom. It's determined by proximity to cash. So how close is that asset to cash? Well, equipment's a lot less close to being cash than inventory is. And assets in general are things the business owns that have value. Now, liabilities is laid out the same way, current and non-current, and expected to be paid or liquidate that liability, honor it within the near term. Versus non-current liabilities, like a long-term loan that you might get from a bank or past. These are the things the business owes. If you, if you take assets and liabilities, take that difference as your equity. And usually it's subdivided between owner's contributions, draws, retained earnings. You see the word capital down there. If you have assets that are greater than your liabilities, you have positive equity in your company. If the reverse is true, then you have negative equity. Equity, oftentimes a lender, before they issue a loan, they want to know that you have a stake in the success of that company. So you have some skin in the game. You're not coming to them saying, please fund my entire enterprise, because I'm taking some of my own money to put in this venture. And again, that's a point in time measurement. So that's a lot I just threw at you. If you have any questions at all, stop me. Because now we're going to look at an example of a balance sheet using all that breakout. We're not going to read everything on here, but there's your breakout between current and long-term, and current assets, and then current long-term liabilities. And in this example, the loan to the bank was a long-term liability, but the correct way to account for that loan is you would pull the portion of that loan into the current liabilities section, the portion that is due within the next year. So it's important when you incur a liability of some significance, that you that it goes in the right place on your balance sheet. I was working with a business that had a long-term loan under their current liabilities, and I pointed that out, and they corrected it and reissued their financial statements to their insurance company, and they got a better insurance rate because the insurance company was reading their current liabilities as too high. And there are metrics that insurance companies and lenders are going to look at. Compare your current assets to your current liabilities. They want to see if things are kind of in balance there. And if they're not, they want to know how far out of balance it might be. Now, under the equity section, you'll see retained earnings and common stock. So in this example, Sam issued some common stock, perhaps to himself. But retained earnings, what is that? That's earnings, net income back from the P&L. These are earnings that stay within the company rather than pay a dividend to the owner. The net income, the earnings of that company, they have to either stay in the company or go out of the company. So retained earnings, they stay within. So your total equity, this business, for example, has positive equity because the total assets of 84.5 plus the total liabilities of 36.4 gets you to 48.1. And the grand equation here, assets must equal liabilities and equity.
Hey, Dave, we've got a question here.
Okay.
Why is inventory a current asset, but equipment is not? Is it based on liquidity? Like how quickly you can turn that into cash?
Correct. Yep. That is correct. Inventory is expected to be sold within the next, I'll use the term operating cycle, but in the near term, it's supposed to be an asset that is expected to be liquidated and turned into cash. And equipment is not. That's the big distinction.
And then what is an example of a current liability?
Accounts payable. So if you're incurring expenses, but you're not expected to pay for 30 days to your vendors, that would be a current liability. If you're withholding federal, and if you have employees, you should be. If you're withholding taxes for your employees out of their paychecks to issue payments to the government, federal and state, tax withholdings is a current liability because you are expected to pay that liability in the near term. And that, again, that contrasts with a long-term liability, something that is expected to be paid off over the long term, like a long-term loan to a bank.
Okay. Another question. If my net income is positive, does that mean I'm profitable?
Technically, yes, it does.
Okay.
It does not mean that you're cash flow positive, however. And we'll touch on that briefly. Those are usually two different things.
Okay, great. I think that's all I've got right now.
All right. Okay, let's go to the next slide. Speaking of cash flows, this statement's really important because it will tell you if you are kind of using cash or is your company generating cash or using cash on a very bottom line basis across all of these types of activities. So the first thing I'll point out, this is a period of time measurement like the P&L. It's not a point in time measurement. And it answers the question, like it's noted there, was the business cash flow positive or negative for a period of time as specified? There's three major sections on this statement: operating, investing, and financing. This is getting a little in the weeds, but it's important.
Okay right now, actually. Thank you, Sophie.
The operating activities is similar to a net profit. So the cash provided by operating activities for your business, it's similar to a net profit on a P&L, except you make some adjustments to the P&L so you can translate that number into a pure cash figure. And some of those adjustments would be depreciation. Or if you charge depreciation on your P&L, you get to add that back on your operating activities. Changes in working capital accounts. We'll talk about what the definition of working capital is in a little while, but what that means is if your accounts receivable and your accounts payable change, then those changes actually are reflected in this operating activities section. And then there's two other sections which have to do with how you fund your business and then what those funds paid for. That's how I think about it. So the investing activities, for the most part, are what those funds paid for, but only on the long-term asset section of your balance sheet. Financing activities, they speak to the non-current liabilities and equity sections of your balance sheet. So it's how the business is funded. Think about what that balance sheet looks like. Those items go there. So again, big picture, P&L is different than statement of cash flows because cash flow measures every dollar in or out, and the P&L doesn't necessarily do that. But they're both important.
Thanks, looks good. You want to take my plate for me?
Guys, can you do us a favor and put yourselves on mute so we don't hear your background noise? And David, there was a question, I think it was from Ebony, who asked, do I need to do a T-sheet with my balance sheet? And Ebony, if I'm not asking that question correctly, please feel free to unmute yourself.
Yeah, that's a good question. A lot of people use T's for their accounts if they're keeping their books in a ledger. If you do it on a computer software program, an accounting program, that'll keep it for you. But you would actually use those T's for your accounts for a balance sheet or a P&L if you're keeping your books in that manner. So not just for your balance sheet, but for all of your accounting, you can do it that way. I hope that answered the question.
Thank you, David.
Absolutely. Okay, now we're just going to look at a couple of examples. All that terminology I just threw at you. This one's a sales example for a product business. So let's say you have a brick and mortar retail store and you sell an item for $150. Your cost on that item was $70. So you got a piece of inventory, whatever it was, somebody came into your store, paid you $150 for it, and now it's gone. How does just that transaction affect your financial statements? Well, that goes right to your income statement where you would have sales revenue of 150. Then you back out the cost of that good that's now gone to give you a gross profit of 80. Now that's not your net income. That's just your gross profit. If you hit the space bar, we'll see the next, there you go. So yeah, your net income's calculated after you subtract all your operating expenses, because your overhead, all those operating expenses plus the cost of the inventory, those are all your costs, not just the cost of that inventory. So a little more complete income statement, obviously with a bunch of figures to be filled in, but this kind of gives you this sense of, okay, I have $80 in gross profit, but that $80, that and the gross profit from all the goods I sold have to go to pay rent, utilities, payroll taxes, insurance, etc. So your net income is the bottom line after all that. Whoops. Well, that's embarrassing. Okay, the 160 should be $80. The $80 is the contribution margin. So that's stated on a per unit basis. And that's what contributes. So folks, just ignore the 160 and think about it as an 80. This is what contributes to paying for all the other expenses. Now next slide, we're gonna look at how that sales example looks on a service business. So for service businesses, some do sell marked up goods alongside their services, but for this instance, we're just going to keep it simple and say, okay, this is a service business. On this transaction, we charge $150 for your cut and color. It's a hair salon. How do the books look after that transaction? And we'll see a P&L pop up here. All right, so it's $150 sales revenue. There's no cost of goods sold, so there's no gross profit in this transaction, but your net income is the bottom line, 150 less all those other expenses. That's a great definition. Thank you, Adam. Cost of goods sold is what the business paid for the item they sold to a customer. So now we're going to look at, okay, what happens on the balance sheet? Now, for these sales examples, the distinction we're going to draw here is whether the sale was made on credit or not. So let's go ahead and look at that first one. This is the cash sale. What does your balance sheet look like for the cash sale? And again, it was $150 transaction for both of our example businesses. For the balance sheet, for the business that sold a good that was costed at cost 70 and marked up all the way to 150, the asset inventory is reduced by $70. And that leaves, a positive 80 at the bottom if you apply the assets minus liabilities to equity. These are just the changes to the balance sheet. We're just pulling out one little transaction and seeing how it hits. Credit sale. This is a little different because there's two steps. Your assets go up because you have an accounts receivable figure. So your assets go up by 150, but the inventory still comes down by 70. The equity is still 80, the difference. But then the bill's paid. You collect from your customer. So what happens then? And we'll see another balance sheet hit. So in this instance, AR or accounts receivable falls by 150 because you collected on that receivable, but your cash went up. So they cancel each other out. Your assets didn't change as a result of the second part of this transaction.
So David, Kiana had a question here about monthly services for services not yet rendered. That would be the balance sheet on the right, correct? Where there's an increase in accounts receivable, but cash has not yet gone up, correct?
Yeah, if you have not rendered the services, have they prepaid? So if they've paid for a service that you haven't rendered, then that's a revenue you haven't earned. So that's an unearned revenue. So that's actually that's a liability.
Sorry, I was thinking something else.
That's okay.
Yeah, that'd
If
be a
I'm reading this
liability.
correctly, yeah. If it's that's what's called an unearned revenue.
Now I'm thinking the inverse. If they, let's say the business renders the service but has not yet received payment.
Correct.
That's where the receivable comes in, and there's no increase to cash, but because they've rendered the service, they've not received. They're due the money, but they haven't received it yet.
Yep. The left-hand side is in your example, Adam, and then I'll fill out the rest of the example for Kiana. But in your example, yes, the accounts receivable goes up on the left. That's your debit. I hate to do this, but this is the way I think. Your accounts receivable goes up, and your revenue, which is your credit, so on the right side, your revenue is going to go up by an equal amount. And the revenue is not on the balance sheet. That's why we're not showing it here. But then when you make that bill, or when you collect on that bill, the accounts receivable goes down, the cash goes up. Now in Kiana's example, it's a little bit different because the unearned revenue is there's your credit side, there's your right hand entry. Because you can't book that revenue, you can't call it revenue yet because you haven't earned it. So if you think about your profit and loss, you can't count it in that top line yet because you haven't earned it. But you did collect cash. So cash goes up on your left-hand side on your debit. On your right-hand side, your unearned revenue, a liability, goes up. Then when you deliver the service, that unearned revenue kind of cancels out. So you draw that liability down, you've paid it off, so to speak. Then you get to count your revenue. So a little bit of accounting nuance there. The thing to remember is assets equals liabilities plus equity. And every one of these transactions has a debit and a credit, or a left-hand side and a right-hand side. For both of us, for people that like to think in those terms. So now we will go. Okay, so now
Dave, there's a question. There's a question on Facebook Live from Alicia, and she asks, "Is there a program or something that can help you understand your numbers? I would like to open a coffee shop. How do I get to understand my numbers?" And I think that Dave, you'd agree with me. The first thing to do is, to make sure you're tracking your numbers. Now, if you're in the startup and planning phase where you're forecasting, we can get you in touch with somebody to help build those financial projections. And but there's a lot of research that goes into building those numbers out. But once you're running your business, making sure you have adequate accounting and bookkeeping processes in place is going to make your life a lot easier. It may add a little more work to your life, but I think in the long run, we would all agree that it's going to make things easier because you're going to know your numbers and know where they come from.
Exactly.
What would you add to that, Dave?
I would add to it, you're going to need to keep your books in some kind of an accounting software program. And one of the things you want to keep an eye on when you make that decision about which program is best is what kind of support and service is available for that program. Meaning, is it easy to go to that company's website and ask a question or watch a video? And the better programs, I'll mention a couple, these are not endorsements, but Zoho Books is one and QuickBooks is another. They vary in cost, but both of those are decent examples of pretty rich websites with a lot of information that you can educate yourself on your books and how a transaction affects your books and why your books might look a certain way. That'd be one thing. Second thing, there's plenty of YouTube videos out there that could give you some of the basics, similar to what we're talking about here today, to kind of reinforce it. And lastly, whoever's keeping your books, if it's not you, you just need to have a good line of communication with that individual. You got to be able to ask questions, and hopefully that individual is going to listen and be able to give you an answer that you can understand. Because people like me, we tend to, we can go down a rabbit hole very quickly with this information, assuming that what we're saying is making sense. And if this isn't what you do for a living, it's just like anything. It might not make sense. So you just need to be patient with yourself and piece by piece, bite by bite, you'll get it.
Yep.
So what I tried to do here is, okay, we've got all of this terminology, right? With the budget, the forecast, and the 3 different financial statements. Where do all these lay in a calendar? Say 2021's coming up. Right across the middle there, you'll see throughout next year, you're running your business. But these statements, financial statements and other financial reports that we talked about, where would you create them, or when do you run them? What do they measure? That's what this is attempting to show you. Balance sheet at the very bottom, that's a point in time measurement. So you'd have a balance sheet perhaps at the beginning of the year and another one at the end of the year. Why would you want to do that? Well, you want to see how your balance sheet changed over the course of the year. What happened to your cash? Did you pay down debt? What is your equity position in the company over the course of the year? Did it go up as you had expected? Before the year starts, so in fall of 2020 coming up, you would want to create your 2021 budget and create a 2021 forecast. And then throughout the year, this is right across the middle there, you perhaps would update your 2021 forecast. So as circumstances change, you want to update your sales forecast. Maybe you didn't move into that coffee shop as quickly as you thought. So your expenses were lower, but you also weren't making any sales. So you want to update that forecast to reflect those changing realities. And as you go, you would compare actuals to budget. And then you would have an explanation or an understanding perhaps as to why you're not on track for your budget. Things changed. Maybe you did move into that coffee shop, but your rent was higher, so your expenses went up. Maybe you changed your product mix at that coffee shop. And so the products that you thought were going to sell really well, they're not selling so well, but others are. And that changes your revenue forecasts, projections, your cost expectations. There's a lot of moving parts here, but this attempts to lay all that out for you as to a plan, a path that you might take to best use these tools to help you manage your business. All right, so now we're going to talk a little bit about profitability and cash flow. So go ahead and, all right. So before we jump into this, again, the big picture, P&L is profitability. Profit and loss measures profitability. Cash flow, you would pull that from your statement of cash flows. So what we looked at before was how a company can be both profitable and cash flow negative. If you let, for instance, again, if you let your customers buy on credit, but payment arrives later. So thinking about how that transaction's booked, you get a sale transaction. It goes to your top line on your P&L, but the cash hasn't hit your, hasn't come in, it hasn't hit your balance sheet. So you have an accounts receivable on your balance sheet, which is great, but you don't have the cash. Now, let's think about how you're running your business and you have to pay for costs. You have to pay for inventory to make that sale. You have to pay for your inventory and your trade vendors. You haven't been in business long enough, so you don't have the relationships and the history with them. They want cash payments up front. So maybe you can see the disconnect that we have here, because you're making sales on credit, but you're paying your costs with cash. And that mismatch can, that can come up, that can accumulate or and make things a little bit more challenging for you. So that's what that fourth bullet talks about, is how you pay for inventory now, but you don't collect on that receivable till later. All right, now here's another way that the cash projection or the statement of cash flows is going to be really important, and your lender is going to want to see that. Well, if a company has debt, the term servicing that debt means you're making principal and interest payments on the debt. So you're current with your debt payments, you're servicing the debt. But each month you're making payments, cash payments. Now, you get into the weeds a little bit with me here. The interest payments on that debt, they're on the profit and loss. So if you think about your that payment to the bank for that loan, a portion of its interest, and at least in the early period of that loan, the larger portion of it is, I'm sorry, I'm going in reverse. The larger portion of it is interest in the early period of the loan payments, and the smaller portion is paying down principal. So the interest payments are going to be on your P&L as an expense, but your principal payments are not. That's just, you're paying down debt, and that's not part of, it doesn't appear on the profit and loss. Where they do show on the statement of cash flows financing section. So you would have that whole story if you had both of those statements in front of you. You wouldn't have the whole story otherwise. Hence why you need the full set of the statements to get the complete story. Hopefully that makes sense. In another way, before we hop to the next slide, another way perhaps you could be cash challenged is if you're drawing cash out of your business, because sometimes you have to live, right? But if you're drawing a lot of the earnings out of that business, yet you have cash obligations like a loan. You could be cash, you could be starving your business a bit on the cash side. You could be cash flow negative for a period of time. That won't necessarily come out either on the, it won't come out on the P&L, but you would need to see a statement of cash flows to get that story. So. Okay, now we're going to talk a little bit about best practices for making those forecasts in your budgets. Now, at the beginning of the year, generally speaking, your forecast and your budget should align, but they're not going to as the year progresses. You're going to need to modify that forecast. First thing you want to do is you want to ask the hard questions, because whether you're going to a lender or an investor or your brother for 10 grand, if they're astute, they're going to be asking hard questions. So you better ready yourself, get those answers ready and be versed with those answers. Next point is if you estimate for your first year of business that you're going to have, say, monthly sales of $10,000. There's nothing wrong with starting with that as a wish or a goal, but then you got to get into that 10,000 and say, okay, what assumptions have I kind of baked into that monthly number? If I'm selling widgets, for example, that would mean every month I'm selling 1,000 of those widgets at $10 a piece. If you manufacture the items you sell, so now you've introduced time into the equation. So you have to manufacture items. So what's the production time to produce one item? Can you scale up? Those are really important questions. There's only so many hours in a day. You have to bring on additional labor to scale up. Can you do that? If you're selling services at $250 price per service, that means you'll need to sell 40 of those a month. So those are the important questions. And you want to ask yourself, are those figures realistic? Right? Are those figures realistic? That's the biggest question you have to ask yourself. And you got to be comfortable with the answer. And then when somebody asks you, you can say, well, they are realistic. I believe I can penetrate this market. I've done my marketing analysis. I got my 7-step business plan. Yeah, it all fits. It tells a story, and this is my story. Another point would be you got to know your costs. So if you carry inventory, my guess is that's going to be the most significant cost you're going to have. When I say cost, it's value of the things that you're selling in your business. So it's a really important figure to get your arms around. And then you want to remember, just some costs are fixed, rent, utilities, but some are variable. Cost of goods sold, the labor to make your sold goods. So you want to treat them differently in the forecast, because if you sell 10 times what you had forecast, your rent and utilities aren't necessarily going to go up, unless you need to move to a bigger space, of course. But your variable costs, all the costs of the goods sold, that would go up. So you just have to be aware that there are different types of costs, and you want to treat them differently. And this is all, again, a sense or a plea to just know your numbers and learn your numbers. And yes, this can be overwhelming. I'm with you there. but we don't want to overwhelm you, and we're going to get you there. All right, so these are just some terms that you might hear. You might hear a lender mention, your banker. We've mentioned a couple of them on our call today. Liquidity. So what's liquidity? Go ahead and hit the slide. There we go. It answers that question. How quickly can my company sell its assets to meet its short-term obligations as they come due? Short-term obligations. Remember short-term versus long-term? And it's used in assessing creditworthiness. Right? That's what is that? What does liquidity mean? That's what it means. Capital structure. So how a company is financed. You, as a business owner, you have a business with assets. How those assets get funded? How they get paid for? Debt, a loan. That's what your debt is, or equity, money out of your pocket, your partner's money out of their pocket. So proportion of debt versus equity. That's your capital. That's your business's capital structure.
Dave, can I touch on liquidity real quick with a real world example?
Yes. Yep.
Cool. So Pat Stone is a small business lender, and let's say somebody comes to us and they want a $10,000 loan. Well, what we want to know is, so creditworthiness is the measure of how likely the lender is to get their money back. So how likely is Papstone to get our money back from a business client? And creditworthiness is based on a lot of factors, and one of those includes the liquidity of the business. And if we look back at an income statement, or a balance sheet rather, if you look back at a balance sheet, things are listed in order of liquidity. So the most liquid thing you have is cash. And everybody understands that term just from personal finances. You want to be as liquid as you can, especially in times like this. You want to have some cash available. Mm-hmm. So creditworthiness is based on that. But when you go down that line, it's also, okay, if we get in a pinch and I can't pay my loan back, what can I liquefy? What can I turn into cash to help make my loan payment and to service my debt? So the next thing is going to be inventory and accounts receivable. So it's things I have that I can sell, and then also payments that are due to me. So liquidity is all about how easily can you turn what you have into more cash, into more real tangible cash in the bank.
Beautifully stated. Yep, that's great. All right, next up, working capital. We'll see that in the next slide. We have a couple more terms. So you'll hear the term working capital thrown around. I like to think of this as the near-term assets and the near-term liabilities, the net of those two. So current assets minus current liabilities. And there are a couple of examples there for you. And those are the net assets available for day-to-day operations. As you run your business day-to-day, what's something that you have that you can use to pay your bills, that you could sell to pay your bills, run the business. Book value and fair value. Back to our example earlier, if you bought a $40,000 piece of equipment to run your business that you needed to buy, the book value of that machine is $40,000. It's a depreciable asset. So you take that 40 and you carve it up over 5 years, and you charge your profit and loss, let's say $8,000 each year for 5 years. So the book value of a depreciable asset is your historical cost, or what you paid for it, less that accumulated depreciation. And the only point I'm trying to make here is that book value usually doesn't equal fair value. So if you had to turn around and sell that piece of equipment because you needed the money tomorrow, well, you're probably not going to get your book value of that asset. Book value of the depreciable asset, fair value is what you get. So they're usually not the same thing.
Dave, do monthly employees do the monthly salaries of your employees get deducted in working capital? That's a question we had come in.
Yeah, monthly salary of employees, that's an expense on your profit and loss. So there's not a direct hit to the balance sheet with that monthly salary expense. I mean, the cash comes out as you expense it, but so yeah, in that case, yes, they would those salary payments would come out of your bank account. So it would reduce your working capital. Correct. There's some more terms. Some of these are terms that your lender might be looking at, and they might ask you, more about it. They might not use the term, or they might. So that's why we're throwing them up here. Current ratio, current assets divided by your current liabilities. Now, quick ratio, if you think just the word quick, what does that mean? Well, it means you got to liquidate things to pay a bill. So what's the most liquid assets? You want to back out inventory from your current assets and divide that by current liabilities. Couple of these, you'll see why you might want to keep an eye on these ratios in some hypothetical stuff coming up. But inventory turnover, it's how fast are you selling your goods? And then that last one is a very lendery kind of term, debt service coverage ratio. Usually banks have a certain threshold. They won't. They need to see a certain ratio of 1.3 or better, or they won't loan you money. I'm not speaking on behalf of Pastone, but oftentimes banks operate in those circles.
Right. So debt service coverage ratio just says you bring in enough money after expenses to cover. You bring in enough money to cover your debt service this many times a month.
Mm-hmm. Yep. How does that money compare to what you got to pay the lender to service that debt? Yep. All right, now let's look at why some of these ratios might matter. So this will kind of give you a sense for, oh, okay, that might be what it's telling me. So gross profit or gross margin. Think back to your profit and loss where you had sales and then your cost of goods sold. And right below that, the difference between your sales and your cost of goods sold is going to be your gross margin, gross profit. So if you have a decreasing gross margin, that might mean your costs of all those goods you sold went up. It might mean your sales went down. Might be other things, but those are two of the most likely candidates. So if you have a current ratio that increases, that might mean that you're reducing your current liabilities. So you're not carrying as many payables. Or maybe you reclassified debt from short-term to long-term. So there was maybe something you were misclassifying, like I talked about before. That could change your current ratio significantly. Now, if that current ratio, which is current assets over current liabilities, if that decreases, that might mean that, okay, you have smaller inventory due to better inventory management, because you don't want your inventory sitting around forever, right? You want to sell it and realize sales on that inventory. Might also mean you're just carrying smaller cash balances. So maybe you're just a little bit more cash strapped for a period of time, and your ratio, your current ratio reflected that. So let's go to the next slide. All right, and three more. Receivables turnover. If you got a receivables turnover that is falling, you might be making sales on credit that you previously weren't. So you're increasing your AR balances, which means you're just not moving your receivables through the process and collecting on those receivables as fast as you used to. Or maybe customers are paying more slowly. And in this economy, that could be something that is causing that one ratio to fall. Is maybe your customers are just having some difficulties paying the bills they owe you. And then a couple on inventory turnover, which is really important for any of your businesses that are running or maintaining inventory. If you have a decreasing inventory turnover, it just means, just think about the English that we're using here, inventory turnover. How fast is that inventory going through your process, and how fast are you realizing cash from making sales out of that inventory? So if it's slower, means maybe that the inventory is more obsolete than you would expect it. It's not moving as fast as expected. Could also mean that you have a lower cost of goods sold. So that's interesting. But if the inventory increased, you might have higher cost of goods sold. Or maybe you're better managing your inventory, so you're maintaining smaller inventory balances. So those are the ratios, some stories they might tell. There's so many ratios, but those are a handful of ones that are pretty useful for any business owner to at least understand what they mean. Now, if you guys have any questions at all.
Yeah, Dave, if we could real quick, I know we're going to have a few questions kind of coming in here, but so if you and I can kind of just state the difference between cash flow statement, income statement, balance sheet, because it's important for business owners to not only know how to access these sheets and know that these sheets are important, but also use them as tools. So when we look at a balance sheet, we're looking at what does my business own and what does my business owe.
Yep.
And those things are listed in order of liquidity in the assets. So it's going to be cash first, and then things like inventory and receivables and all that, until you get to, equipment, things that are harder to turn into cash. And then the income statement is money in versus money out. And maybe, Dave, can you take a minute and kind of explain the difference between the income statement and the statement of cash flows? Because I think that's probably where it gets the trickiest. Even with people who maybe they don't do a ton of receivables and payables, but there's still some issue there.
Yeah. The way I like to think about the cash flow, the statement of cash flows or the cash flow statement, every transaction that hits your bank account is going to be on that cash flow statement, some way, shape, or form. Not every transaction that hits your bank account is going to be on your profit and loss.
Can you give us an example or two?
How profitable you are, your earnings, which not necessarily the same thing as whether or not your cash flow positive or negative. It can get a little confusing, but.
Can you give us an example of a transaction that may be on the cash flow statement, but not on the income statement, one that may pertain to some of the small businesses here today?
Yes.
Maybe catering or something?
Well, I like to go right to paying down a loan. So if you're paying down a loan, you're making your payments. The principal on that payment is not on the income statement. That will appear on your cash flow statement, but it's not going to appear on your income statement. The interest is going to appear on your income statement. So
okay,
that's a good one. Another good one is you get the proceeds from that loan. That goes on your cash flow statement, but that's not revenue, so you can't count that as sales, so it doesn't appear on your P&L. Now, what you do with those proceeds, it hopefully will generate income, the top line number on your P&L.
Okay, that's
they
good.
They are different. And, yeah. Training for QuickBooks. The thing I like about QuickBooks is that they do have a lot of videos at their website that show you how to use their products. They tend to answer questions pretty well. there's QuickBooks professionals that weigh in on their chat boards and whatnot, and they give a lot of really good information. I'd try that first. I'm sorry.
Barbara Robertson asks, what about online businesses selling services? What is a simple format to use in terms of keeping track of sales and revenue, or is there no difference?
For an online business for selling services, yeah, Dave, do you have any suggestions there?
Not online versus brick and mortar necessarily. What are you thinking, Adam?
Yeah, I think it's for me, it all comes down to what you can use versus whatever service you use, whatever bookkeeping process you use that makes you most comfortable with it and that you're most likely to use regularly rather than putting it off because it's confusing or you don't understand it or whatever that case may be. Whatever you can find to use and to keep track. Some people use, they make their own general ledger in Excel and some people still, keep it by hand in a book. I know we've got a lot of people on the call here today who have talked about keeping it in a notebook or something like that. It's good to have it digital. If you can move it to a digital platform, that helps out a lot. Just in kind of planning and long-term growth and projections, and also taxes, which is the bane of everybody's existence. But the more comfortable you become with the platform you use, that's the most important thing, I think. And there's the difference between an online business or selling services or product versus service is not so important as your comfort with the tool and its abilities.
Yep, well put.
Adam and Dave, I'm just wondering if Barbara is perhaps thinking about an e-commerce integration tool as opposed to, for example, QuickBooks or a bookkeeping software.
Yeah, I know that certain e-commerce sites can either export the data to QuickBooks or can be integrated. I know like Square and I think Shopify can all do that. It may not be a direct link, but there's definitely a little more ease of use between larger brands like that.
Mm-hmm.
So let's see. Any other questions out there, guys, before we start wrapping up here? Anything else we can answer? Are there any if you guys want to unmute and ask a question because it's a little complicated to put in the chat, feel free to do that too.
There is someone who is showing as 16465. If you could please just type your name in the chat so we know who you are, and we'll be able to record your attendance correctly. That would be great. I did send you a private chat with instructions on how to change your name on Zoom, but perhaps you didn't see that. If you're showing up as 16 as a number or a name that is not reflected on your registration form, please type that name into the chat. It's going to be very important in helping us document who attended which workshops. And if you are going to request a lunch voucher, we want to make sure that you get your lunch voucher. There's someone also showing up as a 347 number and a 716 number. Please either put your cursor next to your number or your name. You'll see a blue box that says more. If you click on that, you will see an option at the very top to rename yourself. If you can't figure that out, just type your name in the chat. Thank you.
Thank you, Dion. And thank you, David. Thank you for all the information. That is, I think that's going to be one that a lot of us can go back to and watch and probably grab something new every time we see it. And that's accounting and bookkeeping and financial statements and records and projections can be daunting, but it's important for us as business owners to understand it as best we can, and then to know what we don't understand and reach out and get help for that. So, David, thank you so much for educating us and bringing us this information, and we will make this available to everybody in our email that we send out after the class here in the next day or so. We will also make this available on YouTube so you guys can watch it when you need it. And before we wrap up here, go ahead and put in the chat what you remember. Lunch is on us. So because we can't all get together and share fellowship face to face, we do want to buy everybody lunch. So if you're in Buffalo, your choices are Manna or Taste of Siam here in Buffalo. And if you're in Rochester, Peppa Pot is our current option. We should be updating. We should get another Rochester option here soon. But so go ahead and put in the chat what you want for lunch, and we'll send out vouchers here this week to those. Jahida wanted me to remind everybody that the vouchers you receive do expire in, Jahida, you can tell me if I'm wrong, September 5th. So you need to use your vouchers by September 5th. We have a lot of people who have still not used their vouchers. Please use those vouchers. We want you to eat on our dime there. So we want to provide you with that and be able to provide that for you, especially in times right now. It's anytime you can get a meal from a friend, go ahead and take that. So
And it's
September
also
5th, use this.
for you to support a small business. So please use your vouchers and support Manna, Taste of Siam in Buffalo, and Peppa Pot in Rochester. And for those of you who are from outside of Buffalo and Rochester, we're so sorry that we are not able to offer you this same benefit. Our service areas are Buffalo and Rochester, but because we've taken all of our programs online, we're able to offer our workshops to anyone in the 50 states who would like to participate, but we're not able to offer you our free lunch vouchers. So I know there was someone from New Jersey on the call this morning, so I'm so sorry about that. Jamina, I'm so sorry about that.
Yes,
I have a question.
Oh, yeah, Jasmine.
Well, I don't have not. Can my husband use my vouchers since I've been out of town for the past month?
Yes.
Dion or Jahida, I'm going to let you guys answer.
Yeah, there's absolutely no reason why your husband wouldn't be able to use it. If your name is on the voucher, and Jahida can speak to this, I'm not sure, then your husband would just say, I'm Jasmine's husband and I'm cashing her voucher for her. But I think as long as it matches, the number on your voucher matches what is there at the restaurant, then you should be fine.
Okay.
Yes, Dion, you are correct. So the vouchers, they don't have anyone's name on them. They have a voucher number on them. And then what we submit to the restaurant is the voucher number along with your name. So just like Dion said, if you want someone else to pick up food for you, or if you happen to be out of town, they just have to say, whose name it's under, but that's not a problem at all.
Awesome. Thank you. Because I'm not going to be back in town till the 31st.
Yeah, no worries. And I mean, we can't let them go without food, right? So send them in.
Okay. Thank you.
You're welcome.
Thanks, Jahida.
No problem.
All right. So yeah, guys, go ahead and put that, whatever you'd like for lunch, put that out of those three choices, put that down in the chat box. And then I want to remind you that next week is week 6 of boot camp. So we have 2 more class sessions before graduation. Next week, which we'll show you on the next slide here, is a time for us to talk about getting your house in order. And we're going to look at being prepared personally and also having a real discussion over business ethics. So the bulk of our time next week is going to be spent on business ethics, and we're going to kind of have the first third of our presentation is going to be from Letitia Harris Officer, who you guys met during Money Talks, and she's going to talk to us a little bit about personal finance and personal credit and things like that. And then Mike McCarley is going to come in and facilitate a discussion over business ethics and how to be an ethical business owner. Oh, hello? We got some folks unmuting themselves. That's okay. And yeah, so be ready for that next week. And I think we're gonna have a lot of engagement next week on those two topics, especially the business ethics topic. So be on the lookout for your meal voucher, and you will be able to register for 2 other series now. Those 2 series, one continues this Saturday, which is our childcare series for anybody who runs a childcare business or is interested in starting a childcare business, or even parents and caretakers who want to understand some of the struggles and the new innovations in childcare in the face of COVID. So please sign up for that free workshop. It's the second of 3 sessions. Is this Saturday at 12 to 1:30, and then it'll follow up next Saturday with the final session. So, and just like Duncan mentioned at the outset of today's program, Tech Talk starts September 2nd, and it is another Pathstone workshop series talking about how to use technology as a business owner and entrepreneur, how to use that technology and those assets to make running your business easier, be more successful, and maybe automate a little bit of your life. So Tech Talks, we will send the link out to that. It should be in the chat as well. And yeah, go ahead and sign up for that. And with that, I want to thank one person who I didn't get to, who I forgot to shout out this morning, Anthony Dixon from SPA Capital. Anthony, if you're still on the call, man, I want to give you a chance to say hey to everybody before we wrap up. I had written down on my notes 3 different times, introduce Anthony, say hello to Anthony, and I totally overlooked my own notes. So Anthony, if you want to say hey to everybody, if you're still on.
Yeah, no worries. I'm just here for support. Great presentation, David. Again, yeah, Tech Talks is going to be September 2nd. I am going to be starting it off with marketing and sales, just diving a little deeper into some strategies that you can use technology for. You're talking about those too. And again, this is a very important part of knowing your numbers. And I like these presentations because you don't have to do these alone. One of the things when I start a business, the first thing I invest in, even if my budget is $1,000, is an attorney, a CPA / accounting. And it's really important that you invest in that, because what you want to be able to do is ask good questions of them. And so this framework gives you that ability. It teaches you some terminology. It teaches you where to come from when you're asking these good questions and hard questions. So yeah, don't think that you have to do this all yourself. There are people who wear this day to day. And the best thing for you to do is just understand what they're talking about and how you can explain your needs. So I hope everybody enjoy it. Thank you again for coming, and enjoy the rest of your day.
Thanks,
Wonderful.
everybody. Before we all go, please send your bio, a little bit about yourself and your business, and your glam shot to Pecky, P-E-C-I, at pathstone.org. That is, if you've attended 4 or more of these workshops in this series, for you qualify for graduation, and we would like to be able to tell our guests a little bit about you and your business during graduation. So send us a headshot and a little bio. And if you plan to say, let's say this is your second and you plan to attend the other 2, just go ahead and send that to us as well. Thanks, everyone. Have a great rest.
Thanks, everybody.
Thank you very much. Have a great day.
Yep. We'll see you guys next week.